Daily Fiscal Pulse for the 22nd of June, 2026. Here's the single-day snapshot through Monday's close. This is what the flows delivered. Before we dig into the numbers, let's acknowledge what's capturing attention. There's no clear dominant narrative driving headlines at the moment. That said, Cerberus reporting 92% revenue growth in their first earnings since going public is certainly influencing sentiment and market direction. Against that backdrop, let's see what the fiscal picture actually reveals. The flow data shows net transfers hitting $15.0 billion. That number on its surface looks reasonable. What's really worth your attention is the underlying trend. The 5-day flow has dropped to roughly half what we've been tracking recently. The story here centers on tax receipts, which contributed $41.6 billion to the day's activity. What's interesting is that equities are pushing through this headwind. ES futures settled at 7,540, staying comfortably above the 20-day moving average of 7,507. Over the last 20 days, the range has tracked roughly 385 points. So we're seeing price resilience despite the fiscal pressure. Zoom out and the deceleration becomes unmistakable. The 5-day average for government spending is now around $18.5 billion daily. Stack that against the 20-day average of $2.7 billion, and you're looking at a clear slowdown. Less spending means less cash flowing through the economy and into financial markets. The result is tightening financial conditions. Year over year tells the same story. Fiscal year-to-date spending sits at $1,017.7 billion, which is roughly 6% behind last year's pace through the same period. That's a substantial reduction in fiscal support, and it matters for system-wide liquidity. For those focused on the long side, the fiscal backdrop warrants attention. We're not getting much of a tailwind from fiscal dynamics right now. The conditions gauge is reading negative 52. But here's the historical reality. We've been in similar positions many times before, and even with tighter liquidity, the S&P has still managed to average around plus 1.6% over the following month. The relationship between liquidity and markets isn't linear. Prices can and do continue grinding higher. The positioning picture adds nuance. Leveraged funds are trimming exposure while margin debt is sitting at the 100th percentile, which is elevated. History suggests that kind of level functions more as a caution flag than a bullish signal. Here's how it connects. With fiscal flows running below prior year levels, there's simply less cushion built into the system. Markets can still advance when headlines are positive, but when risk emerges, like an escalation in areas where there's no clear dominant narrative, downside moves can accelerate because there's less liquidity underneath to cushion the fall. One detail to monitor: we've seen 3 straight days of declining fiscal transfers. That pattern typically shows up in market behavior within a short window. A couple of dates worth tracking. The 24th of June brings the SSA payment cycle, the 4th Wednesday of the month, and that typically shifts short-term flow dynamics. The data is definitely showing fiscal drag. What's less clear is whether the tightening pace is stabilizing. The next inflection point likely hinges on how these scheduled flows execute. That's the current state.